Can you guys hear me? So maybe I should just start. So, I think my experience is unique in that, like John, I come from the corporate world, but I come from the institutional real estate world, and I come in reverse. Most people start out and they're, real estate agents, they're buying properties and they're growing from the bottom up. And I don't want you to think like, I'm not talking about elitist stuff, I'm just saying I came in and went from the top down to more of the consumer side of the business. And my experience generally is glass half empty, right? My first job, as an example, and I'm gonna blow through my background because my wife said, you don't want to get slapped like Chris Rock and whatever. So we'll keep it quick and simple. But at the end of the day, my first job, I roll over and a plane hits the World Trade Center, and I'm just getting out of college. I don't really know what the hell I want to do. I love real estate. The guy I play golf with owns 20,000 apartment units, and he's in Boston. And just by chance, he drives back from New York with my future boss, who he convinced to hire me as an analyst, underwriting institutional multifamily properties, right? So here I was, I didn't know shit about real estate, I didn't know shit about multifamily properties, and I was in what was a recession, dealing with all the capital markets nonsense, dealing with trying to learn how to underwrite real estate. Back then you really couldn't go to school to learn real estate. You had to sort of teach yourself. I knew what I knew was computers. I knew how to build Excel spreadsheets. So I was your Excel nerd. So when John's talking about data, that's all that matters. Data is not everything that matters. It's not. And I say that because you can go on Zillow, and I'm going to digress and be all over the map because it is a Pints and Properties event. But here I was yesterday underwriting a deal in the Cape. Zillow's got a $1.3 million value on this single family house, and you talk to the guy for 10 minutes and you realize that the house is about 5 years away from falling into the ocean. So that's my world. That's where I grew up. That's how I learned real estate, is from a glass half empty, perspective. And if you don't have that perspective, you're putting yourself at risk. I don't care what you're doing. You have to know that your plan is your base case, best case, or your base better, best case, whatever it may be, but you have to have the downside scenarios covered. What's your exit strategy? All this stuff. So this is what I learned as I'm going through dealing with institutional multifamily projects. I'm learning markets. I'm learning, these big REITs are buying 400 units over in Santa Monica, and I'm going from Boston to Santa Monica, learning the nuances of markets, how to analyze markets, why markets matter, why data matters, why absorption rates or concessions, lease, and there's a lot of different things that go into multifamily that you quickly get. And it was a very interesting. It was a steep learning curve, but it all, luckily for me, boiled down to a model. And I knew how to do Excel. I ended up being relied upon, and also I could golf a little, so I got to go play with the senior management, so I could kind of get ins and learn about the high-level aspects of real estate. But at the end of the day, it became about the numbers and year one, year two, stabilization, how fast you were going to stabilize, what it took to understand how your competition works. And when you're in those markets, it's different than the Northeast. When you go down to Florida and you look at an apartment building, there's two other ones literally diagonally across the street. And it's like going from Burger King to McDonald's to Chick-fil-A to Chipotle. You know what everybody's charging, the market is very transparent. You come back here, and this is why John is so valuable, is because the data becomes much more difficult to get. You don't know who's doing what, and all the data you get is all in the rears. So you have to also understand what it takes to get to year one and to ultimately hit your performance. So I literally was doing first mortgage, real estate underwriting. I'm talking $300 million, and they'll get all, $300 million. No, it's just many zeros. It's still a box of income. And that's a 4-family, that's a 200 unit. They're just different, but they're all income producing properties. That's what it all comes down to, right? So I went and did the first mortgage financing, got trained like you wouldn't believe, and then ultimately went to Bank of America and was an investment banker doing subordinate lending, high yield lending for high-rise condominium units in New York City, right? Where we were coming in for a second mortgage piece where guys were putting 5 or 10 million in, they were using us for another 25 million, and then Bank of America Senior would come in, finance 280 million. And we were dealing, it was crazy, right? But that's the piece, and we were charging 14% for that money. So I came right up the capital stack, and it became a very interesting education because ultimately, and ironically, I joined a hotel company in 2007. 2007, if everybody remembers the peak of real estate, what was 2005, 2006, prior to the housing crisis. I joined in 2007 because you guys know my timing already, right? I leave, my first job is coming right out of 9/11. My next job is going right before the capital markets just completely implode. And I mean, Lehman's going under, everything, all hell is breaking loose. And, so I find myself in a workout, a distressed debt situation where I'm literally negotiating with our creditors. I'm running capital markets. We have a $2 billion debt portfolio and we're hemorrhaging money. And hotels went, like hotels are always the first to go, right? Nobody travels because they don't have any money. People need a place to live, apartments are better, they end up paying their rent, they don't go to Disney World. So we ultimately had to negotiate the debt. We're buying debt back at a discount. I was just talking to Roger, where is he, about literally financing a hotel in 2007 in July. We got a $121 million note from Wachovia on a $175 million appraisal. Wachovia calls us in January, we're fucked, excuse my language. And we bought that same note back for $6 or $7 million less than what they had financed it for, with financing from Bank of Scotland. Bank of Scotland finances almost all of it, thinking this is a great deal. We ended up buying the note back after Bank of Scotland goes under in 2009 for $68 million. But the property was worth, literally 2.5 years before, $175 million. So that's the world that I sort of kind of came and went and was dealing with. And yet my background, because I was institutionally trained in multifamilies, ultimately became an interesting proposition for me, because they decided, shit, the hotel space is awful. We need to diversify. We know that you can do hotel financing and it was great, but we want you to take your experience and start doing acquisitions for apartment communities. So we went out and bought a 400 unit apartment community in Dallas. We were going to build a whole big division of a couple hundred unit apartment buildings all over. And my CEO, I'll never forget it, he calls me into his office, and he slaps down a portfolio and he says, I want you to buy this. I'm like, what the hell is this? This was like, I want to say like summer 2010. 1,000 houses in California. I want you to buy them all. Go to your desk, figure out how we're going to do it. And I'm like, okay, well, what am I going to, what do you mean? I'm like, I've never done 1,000 1,000 apartments, fine, I can figure that out. We can talk about it, we'll build a management company, the whole thing. 1,000 houses, all up and down Southern California. And I was like, beautiful, like I can go to Southern California, it's hot, it's nice. And yet at the same time, I'm like, this is ridiculous. How are we going to manage that? So that's when I went to him and said, listen, we started TPG Residential to buy apartments, that's great. It's time to move into the residential space. And this is where I think my experience becomes interesting, because the Burr strategy is something that people talk about all the time. It's breaking down as we speak, and most people don't see it in real time like I do, but it's breaking down. But at the end of the day, the goal was to buy 1,000 houses. All that happened was he said, well, fine, if you can't buy 1,000 houses in California, we're based in Rhode Island, I want you to buy 1,000 houses around here. So, sure enough, we had to build a business plan. And we built a business plan to go out, and we raised high net worth capital. We went out and found a bank to come in and finance with a facility. It's a $10 million facility. It started out with Navigant Credit Union, and we'll talk about the next part of it. And then the business plan was simple. We're going to build brokerage business in every state we're in. And I'm going to run point up here. I'm going to have a broker in each state. They're going to represent me and the entity. They're going to buy on my behalf. And they're also going to turn around and help oversee the renovation and ultimately manage the property. And then while they're doing the management of the property, after they buy, renovate, and rent, then they're going to turn around and build a brokerage business that can then be profitable before it's time to go sell the property. And ultimately, we build out a residential division on, well, the seller's dime in reality, right? Because they're paying commissions ultimately to my agent who's buying on my behalf. And I'm using that money to pay for the management and the incentive to get this business profitable. So they go out and bird dog properties, and it's funny because John mentioned it tonight. He's like, we targeted 10% cash on cash. Well, that's what we did, but we did it unlevered. So we were buying properties, and this is where I think if you haven't been investing in real estate for a long time, this is where I sort of blow people's minds. So the business model that we had, right, we were buying properties in Rhode Island, Connecticut, and Mass, so Attleboro, $100,000, $30,000 reno. I had an interior designer come in and lay out a pallet. You know, here's your granite, here's your kitchen cabinet, Home Depot, here's your everything, your carpet in the bedrooms, you know, your everything laid out. And we just went. And John's buying a lot of property. I think I got him beat though. I think we did about 28 closings in a month. And we were doing that many properties. We couldn't go fast enough. But at the same time, we were having trouble keeping up because we also had to manage the renovations. So but at the end of the day, we were seeing these cash on cash returns. Now, so the goal, right, is you buy, and it's the numbers, right? We talk about this, right? You buy it for 100, you renovate it for 20 or 30, and then you rent it for $1,300. And imagine that, like the same houses right now are A, selling for $375, $400. B, they're probably renting for $2,000 to $2,500 a month. And that's where the market was then, and that was the opportunity. And we couldn't buy enough fast enough here because it was hard to scale in New England, right? If you went down to Atlanta, so quick story. So we knew that we couldn't get the scale, right? Because every street in New England is different, right? Every street, right? One property is worth X on this street, one property is worth Y here, and you have to manage that. You can't literally do like an iBuyer program like Redfin has or Zillow failed to do. You just couldn't do it. So I go down to Florida, and I go down to Orlando for a week. I meet with whoever we've had in mind to do acquisitions, and I sit down at her desk in her house, and I said, how many houses can you buy? We have all this capital. How many do you want to buy? And I was like, I don't know. She's like, we could do about 100 a day. And I went, what do you mean 100 a day? How are you going to manage the renovations? It was insane. It was all computerized. See, Florida's way ahead of New England in terms of like public records. You know, we have to figure out how to get on Vision. We have this. No, their core, all the REOs, all the foreclosures were all going on online, and and then you go to the court step. I mean, you could, any which way, you could buy way more properties than you could ever manage in a lifetime. And yet, we weren't big enough. We weren't the group that was willing to basically pay for the infrastructure to come in, set up shop, open an office, and position ourselves to manage it, like Colony Capital, Blackstone, all these guys were. So I come back from Orlando, and I'm like, listen, we're not going to be able to do this. So at the end of the day, it became too much risk, and we started to evaluate this whole high volume buyer program, the scattered site, and how hard it was to really manage it. It was the contractors, found a couple of them were stealing money. I have stories like you wouldn't really. One guy got shot on the front step of the house in Pawtucket. I bought a house within the hours of the final walkthrough and the closing. Somebody passed out, backed up, hit the side of the house, and nobody knew who was responsible for the damage. Like, just so many stories, and it became at the anxiety level of going to the investors, A, explaining what was going on, but B, also trying to get scale to generate that real return that they were looking for. Because again, I was working for a $3 billion company. You can't just, they weren't interested in 150 houses. They wanted to buy 1,000. It wasn't worth their time and effort. So I went to them and I said, listen, I'm out making 20, 30 offers a week. I'm losing bids to mom and pops all the time. They're coming in cash, but they don't have cash, Mr. Prakashanti. They're backed by hard money. We gotta be lending hard money. We're too big to be managing the day-to-day of real estate like this. We have to go and lend money. And that's when that's when they realize, listen, who we are is it's better to shuffle paper. So we're gonna start lending hard money. And at the end of the day, if you recall, if you guys were, looking at real estate at the time, there was no liquidity in the market. You couldn't, and it's very similar to today. I was gonna ask John, I was gonna raise my hand and put you on the spot. How many offers have you made with financing contingency?
Probably half.
Half? Okay. What do you see in right now selling? Like, my experience suggests that if you're not a cash buyer on the, let's call it the owner occupant side, coming in and buying maybe your flip, you're either you have to be a cash buyer, or you have to at least position yourself as a non-contingent buyer. You're unlikely otherwise to buy, or to get to win the bid, right? Mm-hmm. That's what it was then, because the banks wanted no nonsense. They were the primary sellers. They were REOs, they were short sales and everything, and that's when the light bulb went off. We can lend in all these states. We got to just make sure people have skin in the game, and at the end of the day, we're going to be able to grow in the same space we wanted to, but do it on the lending side. And so that was, for me, the rest was history, because I come from an institutional financing background where, closings take 5 months. I'm not even kidding you. On the apartment side, they can take 4 or 5 months, due diligence periods. At the very least, they're like 60 to 90 days. This business was just as fast paced as this whole fix to rent, aggregate a big portfolio where you're cranking. And it was exciting, and yet it was easy because we had already gone through 150 houses. I knew how to renovate them, and I knew how to buy them. I knew how to sell them. I had a whole team. So any investor that came to us was throwing money at us left and right. Well, who's better to lend money in this residential space than a group that's already been on the other side? You're just basically giving them 75 cents on whatever dollar. The borrower's coming in with 25. If they have to take the property back, it's probably going to be more profitable than it would have been otherwise. And that really is the how I got into this business. We ended up in my time, and this was before I joined ABL, and I'll get into it. But at the end of the day, we grew. I'd never made a hard money loan before in my life. I never really originated a loan. I was an underwriter trained, and I had the acquisitions experience. And we started lending. My first loan was in Newport, Rhode Island, and I say it all the time. Guy bought a house cash for $1 million. He went and put $250,000 into a reno, and came to me, and I lent him 12% money, 4 points. We closed in a week, and he was thrilled. He had $3 million in stocks. He didn't want to sell the stocks. He just was like, I just don't want to deal with the banks. And it was like, holy shit, this is crazy, right? 16% unlevered, right? We were just talking about 10, right? So I then went to the bank, found a way to get a facility out at what was 5%, 6% money. They lent me 50 cents on the dollar every one that I lent, and now all of a sudden my return's in the 20s. And from 2014 all the way through, we ended up going from, let's call it 0 to what? We went through Navigant Credit Union to about 30 million. We went through Webster to about 50 million. And a year and a half before I left, we had Goldman Sachs come in and give us a $100 million facility. And it was a ride. And the reason is, and this is where I'm going to start to get into what I do now, because it really matters. Like, the history of hard money is a stigma, right? When I say hard money, everybody goes, ugh, nobody's bankable. They have shit credit. They have, whatever. It's just a stigma. And for a while, I was sort of playing into that. I call myself a private lender. That's really not accurate, because that's not how people define. But the truth of the matter is, we're just in the speed of money business. We're basically positioning investors with access to capital. And when Colony Capital and Blackstone realized that, like us, they could buy all these single-family homes in markets that were really like Atlanta, right? Go to Atlanta, go to a planned unit development, there's 1,000 houses that all look the same, right? They're painted different colors, one's outdated, you know what they're worth. Every single day of the week, you can look at them from 30,000 feet, you know the risk, easy to buy, right? But what they did is they turned those people around, and then they made those same people lenders. And all of a sudden, the world of hard money went from country club money to institutional Wall Street money, where it became a recognized, let's call it, source of financing for investors that really needed it. You know, it was REO property. These houses that were being foreclosed on were left like what John showed on Pickering. You needed renovation money, and the banks are the worst. They were overregulated. You know, they just clunky to begin with, and you already know that they couldn't finance the buy to begin with. The banks wouldn't allow somebody to come in with bank financing to buy it. It was like, it didn't make any sense. So here we were, and to me, at the end of the day, and I say it here, it really is the purest form of lending. And I make a joke, because hard money lending, private lending has been around as long as prostitution and gambling. Period. Somebody, call your uncle and borrow money, right? That's what it is, and that's what it started like. That is where the world, and it's evolved. So, at the end of the day, the world of hard money, the stigma's gone forever. The move away from this idea that you needed to know a guy who knew a guy just kind of goes away. And now it's like, all you got to do is Google it. And that's where it's funny, because, I'm not going to talk about, why I think we're great in terms of hard money lending. I built a hard money lending shop. I was running the debt fund. It was stressful as hell. I was the marketing guy. I was the originations guy. If I was building the debt or raising equity, I wasn't lending, and so it was I was in this rat race. I was in this like hamster wheel. So I joined ABL to kind of get out of it and manage clients and manage what I like, which is I'm a deal junkie. And the irony is that this company was a few years ahead of me. They were in 2000, I think they were, formed in 2010, formed by a guy who still runs this today. He was a former Morgan Stanley guy who got flushed out. I think he managed 5,000 employees in their home loan division. And he started a hard money lending shop in New Jersey. And he was on the front line. So when you're me, and my background is different, right? My access to capital was kind of what I know, how we finance hotels and whatever. Income, and this is a group that was built with networking from Wall Street that had the efficient capital and knew enough, because they were sort of financing only in New Jersey for several years, that you needed to be local, right? We're in a high touch business. This is not like, you can get scale in this business, sure, but you're going to be clunky, right? You need to have boots on the ground, and you need to be able to know and talk to your clients. You need to know the local market. You have to know the dynamics. It's too risky otherwise. And yet at the same time, you need to have appraisers that are local. You need to have attorneys that are local. They both insulate you from risk, but they also help the client, and they help facilitate the transaction, more importantly for you than for us, because at the end of the day, we're in the speed of money business. If we just sort of employed or brought people on that were outsiders, then inherently you're going to have bumps in the road, and you can't afford that in this business. So at the end of the day, I'm going to talk a little bit. We're going to go into some questions. You guys can ask me whatever. I've seen a lot, and I've foreclosed on people that I never wanted to. Oh, John, you're going to have to help me out. We have no internet, and I don't know why we would need it. Wait, hold on. Okay. I don't know what I did. Something's going on. I can keep going.
It's still up.
Yeah, it's still up. It's just I don't think I. Oh, okay. All right. So why people use, and I'm just, and listen, I always say, I love to think that we're going to make every loan to we're going to make every loan to John. We're not. John's going to have other lenders. He has, he talks to Michael Corrigan, he has access to other lenders. That's not us. We're going to be there for deals that work for us, and we're going to execute. There's no way we're not. But there's going to be permanent financing solutions and other things, buying 200 apartment units. Wherever John ends up growing to, and I have no doubt he's going to outgrow us. That's why you want to always be talking to different lenders. But why we exist, and why generally hard money exists, and why I think we're good at what we do, is that we're fast, right? I mean, our loans, literally, you give me your information, it's like 4 things. By the end of the day, your loan's approved, right? We had a loan approved on Thursday of last week, and on Wednesday it closed. We had an appraisal. The appraisal was in on the Tuesday. We were clear to close by 4:30, and we closed on that Wednesday. So there are, and there are other lenders, sure. That's what the whole industry is about. Because ultimately, right, it's the opportunity cost. If you are in real estate, and everybody is, you make money on the buy. You don't make money. You make money on the buy. That's it. If you make money, if you buy it right, it fixes all the other problems. And if you have opportunistic capital that's behind you, my borrowers use me like cash. There's no financing contingency. They come in, they offer cash, but they know we're going to close. And they know that their deposit's not at risk. And you need to be aware of, that's the key, right? Again, always the downside. I'm going to just put $10,000 down. What happens if the lender doesn't close? That's real. And during COVID, half the hard money lenders went completely out of business. Gone. Overnight, gone. They didn't have a balance sheet. They couldn't lend anymore. If you had a contract and you were expecting them to close 2 days before, you were told, sorry, you're shit out of luck. We have no money. You couldn't do anything about it. That, to me, ultimately, in the end, is what it means. And that's important, right? So you're buying distress, you're buying as-is sales, you're buying foreclosures. Those aren't financeable properties from the bank's perspective. You need hard money, you need cash. You need it to compete in today's market. You can't make, as I said to John, and John knows, and you have to have access to non-contingent financing. You have to be able to make that non-contingent offer, right? And again, making money on the buy, that's key. And I told you pros use us like cash. We talked about how we're local and built for speed. There are companies out there, use appraisal management companies. You get some random trainee appraiser and they don't know what the hell they're doing. They're in Lowell for the first time. We use folks that just know the markets and that I've used for years. And it's such an important thing. And it's also access to capital. So let me go back, right? So I built this lending platform that was financed by Goldman Sachs, but my capital was still too expensive. I had to still lend at 11 and 2 to hit my investor returns. With this company, we have access to a much different diversified capital base, both our own money and note buyers, private equity sources, life companies, and all the others that are in this space. They know, and that allows us to drop rates down to be more competitive than your local yokel hard money lender. Doc Light, right? No tax returns. No financial proctology exam. I mean, let's be real. If you're going to a bank for financing, the processing list is never ending. I need you to verify your bank statement from 2 months ago. But can you tell me, where did the money come from? And you're like, what are you talking about? Like, I work for a living. It doesn't matter. They still want to know. So, we have no prepayment penalties. We have 0-point programs. We have programs that we want you, right, to go through the project fast. Our loans are 12-month terms, right? You're like, oh shit. But the fact of the matter is, you're a flipper. You should be in and out. You use us for speed. It's time value of money. You want to be in and out, and you want to be able to know your exit strategies, and we can talk a little bit about that. But and then as a company, we have an experience model, right? So we finance first timers. We're going to lend you less, maybe we'll make you put a little bit more down. But we're going to finance you, as we've done throughout our history. It's more risky, right? So your rate's going to be higher than John's. John's going to be a lot lower. He's got more experience. And then there's 100 different experience levels in between. And you're going to get rewarded for your experience with us as you grow. And we're going to drop rate. And all of a sudden, you're going to go from 20% down to 15% down to 10% down. And that's just how we feel. It seems logical to me. More experience you have, the less risk we're going to reward that and give you better terms. So construction, that really is the name of our game. It's just not happening. So we feel like in New England, the opportunity is fix and flips, condo conversions, some infill ground up, but it's Florida, it's Texas, it's other markets the Carolinas, where we do a lot of construction and we do it fast. I mean, again, draws are fast, the whole thing. And then finally, the BRRRR strategy. We talked about it. I lived it. And I can tell you how we're breaking down in the Q&A, but at the end of the day, we're going to be able to do your fix to rent, your quick buy, your renovation. And then we have a 30-year program for investors where you can lock into a 30-year fixed rate. That rate is wild right now. I mean, it was 4% 3 months ago, now it's 7%. And it's been fluctuating, the volatility in the market. And I know I'm talking 100 miles an hour, but at the end of the day, it comes back to the numbers and making sure that you have a finger on the pulse so that you know, A, how it looks as a flip, but B, if you're really truly holding for the long haul, how your exit strategy works. Because if your exit strategy works, you can sell it, you can condo it, you can in pieces, you can refi it out. Worst case, you're covered. And ultimately, if you look at everything from a glass half empty perspective, you're never going to really be, in my mind, at risk unless the market just implodes. You're going to have your bases covered, and to me, ultimately, that's all that matters, right? Protect your investment capital and just continue to grow. And if so that's really my presentation. I love Q&A. I honestly have crazy stories. Again, ask me anything. I think I've seen it all. Foreclosures, you name it. The best and the worst. So, go
Can
on.
you talk a little bit about the BRRRR? Because my understanding about that is that when an investor refinances the property, that it's 100% tax deductible, but that's if the appraisal comes out good. But what some people right now are finding out that their property is appraising less than it did when they originally bought it, so now they're losing money on it. So you were saying something about the BRRRR starting to go reverse.
So the BRRRR strategy getting a little bit more difficult, right? You can talk to your accountants about tax strategies. I never advise any. I mean, obviously it's better to refi than pay short-term capital gains, but that's a whole different thing. Where I worry about the BRRRR strategy breaking down right now is interest rates, right? It's circular, right? So I give you an example, right? You buy a house in the fall. You're looking at your model. You're treating the purchase and the rental like a flip, always. So I'm going to buy it today. It's going to be worth this. I'm going to renovate it for this, and it's going to be worth that, as if I flipped it and sold it to an end buyer. Well, but if I don't, again, back to always look to the downside scenario, you're doing in the numbers, and you're saying, okay, I'm buying it for this, and my ARV is that, and my LT ARV, my loan to after repair value, is going to be 65%. So that's awesome, because I know a lender that's going to refi me out at 80% or 75%, whatever it may be. Well, your cash flow is also based on underlying interest rates. Now, rents have gone up, and expenses haven't. Expenses have definitely gone up. We know oil and everything is more expensive, but rents have gone up great. So a rising tide lifts all boats. But with interest rates going up 250 basis points, the exit interest rate that you were underwriting in the fall, now doubling in the spring, becomes very difficult for you because you have that value. You know what the value is. The value hasn't gone down yet, right? We all know the market's still tight. It's probably going up a little bit, but the cash flow no longer supports the debt service. So now the lender's saying, okay, well, that's awesome. Your LTV is low, but you're at a 0.9 debt service coverage ratio. So you need to invest more money to refi the loan out that you took in the fall. And that's what we're seeing. And I'll give you a real example. A week ago, a woman comes to me. She bought a property in the fall with 10% down money in Beacon Hill, $10 million, 12 units. She, put $1 million down. She was going to renovate it. She did a little renovation, but the rents didn't hit the level that she thought. Come through the renovation, she's rented out. She's cash flowing in her mind. based on her exit interest rate that she had projected. Now she's got to come to the table with $1 million to refi her existing loan out. That's maturing in 6 months, and she doesn't know what to do. And that's the world that we're in right now. It's a bumpy road right now. It's Fed, and I could go on and on. I sat and listened to an economist today. You know, the Fed they just raised rates 50 basis points. There's 5 more meetings, 2 of which they're expected to raise another 50 each meeting. So I don't want to get into the weeds, but at the end of the day, what are we going to expect? We're going to expect a rising interest rates. So I happen to be, I'm not bearish on the market, even though you all know I have a glass half empty view on things most of the time, but it's still nationally, there's 900,000 units on market. There's a demand for about 3.3 million. So we're still seeing the millennials drive demand, and with the lack of new inventory coming in New England, I don't see the market imploding, but I definitely see it softening a little bit, and that's where the tight underwriting, your data, your exit strategy, you really just have to be super refined on it, because listen, who has money to lose? I don't want to lose any money. Nobody does, but that's where the rubber meets the road. It's the data, so it's all fun. We all love when markets continue to go up. I made a hell of a lot of money in tech stocks until I just lost a hell of a lot of money in tech stocks. But that's the way of the world. It definitely is cyclical, and yet I don't believe we're going to be back to where we were when I was buying houses in 11 and 12. I just don't. It's just, I don't see it's not possible. It's and in markets like this where people can move to, and it's just a different time. Any other questions?
So if you had like a $500,000 buyer, before the basis points started jumping, where are they at now?
$500,000 buyer. What's the strategy?
Well, if they were at, so say when the interest rates were at 2.5%, what's that buyer at now at 5%?
It's not like that in my
300,000?
business. Well,
No, I know. I'm just saying in general.
So at the end
Because
of
that's the buyer that's going to be buying the property from you, is what I'm saying. So the pool of $500,000 buyers after the flip's done, what is that pool now? Are they at 400,000? Are they at 300,000? You know what I mean? Like, what is their money?
so that's the thing. I'm really in the investor space. Mm-hmm. So projecting what that end consumer can afford.
Right.
Maybe John can speak to it because he's more in the, he's got his agents representing these folks who are being qualified for certain amounts. Yeah. In my space, we don't care about debt to income ratios or anything like that, right? If you come to me and you say I have $100,000 in the bank, yeah, and I want to buy a $500,000 property and my credit's 660 and I've done 5 deals, I'm going to say, okay, your rate's going to be 8.75%. I'm going to lend you, 85% of your purchase and 100% of construction. Let's close. Done. I don't care if your tax return is shit. I don't care about anything like that. I just want to know that you have enough money to get through the construction, and then also put the money down for the down payment. But that's where my world goes. The exit strategy, and that's where I always think you got to be careful. And maybe maybe you want to speak to it. Are your agents seeing end buyer, pressure? Are they stepping back and maybe, instead of buying that $500,000 house, saying, "Well, honey, we can only afford $400 now because rates have gone up"? It seems.
So we're starting to see that particularly in Boston, where property values are higher. We've seen a lot of buyers kind of exit Greater Boston just because going from a 4% interest to 6% interest has a big impact on monthly payments. But in the suburbs, probably 30, 45 minutes outside Boston, still very, very strong. Like I said, we had a condo that we put on the market for $300. We had many offers over asking in the first weekend, but a couple of months ago we would have had probably triple the amount of offers we had. So we're starting to see people back off a little bit, but I think it's just there's still not enough supply, and so the demand is still there.
Right. I'm just thinking of as you take the hard money, you do the flip, and then you go to a retail buyer to buy you a flip.
That's what we do.
Yeah. No. I know. I did it for a lot of years. I'm just curious as to how much, 4 point, like if you go, depending on how far back you go, you go back to when it was, 2.25, and now it's at 5, and you're saying another basis point might put it to 6?
In terms of like the exit financing, I'm
Right.
when I talk numbers like that, I mean what 30-year traditional consumer mortgage rates are, right?
Yeah. Yep.
We're unregulated, and
No,
that's
no.
the beauty about what we do. But because of that, we're lending you private capital that requires a higher return.
Right.
So it's a little bit different. Also, so it's a little bit more complicated. But I see what you're saying. It's for us again. If you're looking at if you're looking at it from the fix and flip or the construction 12-month side, it's experience. If you're looking at it from the long-term DSCR program to complete that burst strategy, we're gonna look at your credit. We're gonna take into consideration that rate,
Right.
and we're gonna see, okay, what's the rental income and expenses? How does the income, the net cash flow, ultimately result? What is the DSCR, the debt service coverage ratio? How does that work? How does that work? And so I don't know off the top of my head, but your point is well taken. It's going to affect what you can afford when you refi, because your cash flow can only support a loan of so much.
Right, and it's gonna limit the pool of potential buyers you have on the back end.
It should. It's already
Rates.
pushing buyers out,
Yeah.
but it just started as a crazy strong seller's market, so it's going to take a while for the
Right.
For it to catch up.
for it to catch up.
Any other questions?
So more of a personal opinion as far as the rates going up, with what you see, is there a ceiling that it's going to be predicted how high they're going to go? And the second part, I don't think I caught your rates as far as the service that you provide. I know it's based on experience, but
Okay.
just the ballpark and the points. And
So I'll start with our rates. Fix and flip, 8.25% to 11.5%, all experience driven, right? And also leverage, same exact thing, right? More experience you have, I'm going to lend you 10%. You only have to put 10% down. If you have 1 or 2 deals, 20% down. It's all a function of what we feel the risk is in the deal. On the other side, rates used to be 4%, now they're 6.5% to 7.5%. And that's the 30-year investor, they call it non-QM, it's investor-only DSCR loan. It's for folks who, again, don't want to go through the bank process, but they need that long-term financing. So where do I think rates are going to go? I think rates are going up. I think right now, rates are artificially, the market's predicting rates going up, right? So if at the end of the day you're a bond buyer and you feel, and every indication is that rates are going to go up, you're pricing that in. And so there are factors that are at play. And so rates right now have gone up, and they've gone up quick. I think that they're pricing in the Fed going up again, and yet at the same time, the increase I still feel is going to push rates higher. But ultimately, I think spreads, and I don't want to get complicated, but you're going to see you're going to see rates start to sort of stabilize. I think inflation is a factor of two things. I think we all know gas is expensive, and that means everything else is. And I feel like if we can right that ship a little bit, you're going to see some of the artificial inflation numbers come out. I also think the government pumped too much money into the market, and they're starting to do, what they call the quantitative easing, now they're quantitative tightening. So instead of buying all those bonds that were these home buyers that were being pooled, and the mortgages being pooled, and the government would come in and buy them at a ridiculously low yield, they're now not. They're literally letting their money come out of the system. And the combination of factors is going to be an interesting time. But again, I stress, I don't feel the real estate values can really go low. The demand is just too high. How are you going to sell your house right now? Hey honey, we can sell our house for $800,000. And then you got to go buy a house. You can't live nowhere. I mean, you have to live somewhere. So at the end of the day, you still have to buy in the same market. And to John's point, you have to buy into that market at a much higher interest rate. So now it's like, my payment's the same. Yay, I just downsized. But wait, that doesn't make any sense. So it's all these factors that are, it's the confluence of events that are happening as we speak. It's crazy. I think I was telling Michael Corrigan before, I think you're going to see a lot of lenders go under, and we're seeing it. I mean, one of the national players in the private lending space just lost $65 million in Q1. Those lenders are really reliant upon certain factors, and so it's going to be. I don't think it's going to be like COVID, where half the hard money lenders went out of business overnight. But those are the things that are in play right now, which I think, for all of you guys, create opportunity. Honestly, the more shit hits the fan, the more stress that hits the market, the more folks like you, if you're positioned correctly, get to take advantage of the market, right? You know, what's Warren Buffett's thing, right? When the tide goes out, you know, you can. Yeah, I don't know what the saying is. Maybe I had an extra pint.
Who's skinny dipping.
What's that?
You can tell who's skinny dipping.
Yeah, exactly. And that's it. And so any softening, all of the people that are super high leverage, like the lady in Beacon Hill, she's fucked. So the lender's fucked. And then somebody goes and buys, Roger, where are you? You go buy the debt at the discount. And that's it. And that's all the world, and that's the world we're in. There's always a buyer and a seller. And who knows what the middle price is, right? It's stock market. And you just hope that you're on the right side of the trade. So, any other questions?
Last question, Michael?
Here it is.
But I hear what you're saying in regards to guys probably going out of business. There's going to be a lot of tough times. Most private lenders have stopped 30-year programs.
Yeah.
They're just doing the hard money.
Right.
And I think it's just for the short, for the short return. They're not looking at 30 years right now, just
Right.
because of this crazy marketplace. So
Totally right. It's a great point. And that's to what I just said, right? When you see Finance of America post a huge loss, it's because they can't project, right? If I have my own capital in, which we do, and it's sitting in the bank, and I have investor money, and I have to deal with my underlying credit facility that is helping, the whole, let's call it, capital position work. I'm not at the mercy of the capital markets, which are really volatile, right? So, and it's funny, the last time I was up here at a Pines and Properties meeting, I was over there with the CEO of the company, and he was freaking out because he had just closed a whole pile of long-term, rental loans, $10 million, pick a number, and locked rate, but a day or two later, the rate that the buyer, it's really not a buyer, it's a syndicate who's securitizing to the market, and ultimately these Wall Street folks are buying, the rate changed, and he was facing $250,000 loss. So what do you think he's going to do? The next week, same day, Thursday, he's going to say, or Wednesday, whatever, he's going to say, shit, I gotta increase my rate, because if I originate these loans, which I can't hold because they're too low of a return, my investors want a 10 and that's a 5, they're going to end up pricing it up, and that's what the end buyers are doing, and that's why the business has gone from an amazing market opportunity to a very insecure, very shallow market right now. And it will come back, but it's just, we're in the discovery period where, again, the buyers meet the sellers, and there's sort of parity and transparency as to where the world is going, And the Fed is really driving it, and they're being as transparent as they can. They're trying to engineer a soft landing. We hope they do, right? They're throwing us into a recession. We all have to know that. The question is it a shallow, short-lived recession, or is it a deep recession? And the beauty about where we are is, if you really study the markets and study real estate values, you got to, again, back to the data, look at the markets. I mean, they didn't really take as much of a tumble. John's point, they kind of stabilized. It wasn't a doomsday scenario in certain markets where you just didn't have that supply. And so anyway, so I could go on and on and on. Any other questions?
Awesome.
You have any, all right.
I think we're all.
All right, cool. Sorry.
Thank you, Michael.
Thank you.